My screen is visible. So now we are going to start loans and bonds part 2. Bonds and loans part 2. Screen is visible. Okay, great. Great. So here also the concept would be similar, that we will talk about few critical terms and there will be some brainstorming, some problem solving exercise. So we start with holding period return, which is the total return earned on an investment during the time that it had been held. So if I am holding an investment for 5 years, 10 years, or 15 years, so whatever total amount that I am earning on that investment is holding period return. Okay. Now there is a formula for holding period return, which I'm going to share, and then we will solve a practical problem also. So this is the formula of holding period return. So what is the income generated plus end value minus initial value? So end value, at the end, whatever value I'm getting minus my initial value divided by initial value, that gives me the entire holding period return formula. So now let us have a quick look. You purchased a stock for INR 50 per share. Over a period of 1 year, you receive dividend of INR 2 rupees per share, INR 2 per share. At the end of the year, you sold your stock at 60 per share. Calculate the holding period return. So you can get back to the formula once again, can take a snip, and then let us solve the problem quickly. Note down the formula or take a snip using a snipping tools, and then we are going to the problem. We'll solve the problem. Done with snipping? Done with snipping? Okay, everyone. What about others? Okay, great. So I'm assuming that everybody is done with snipping the formula. Now look at the problem and solve it quickly. This is the problem. Find out holding period return. %, correct. 24%. So Akhila, it's 0.24, 0.24 is a 24%. What about others? Yes, so it's 24%. Okay. Now, before I come to clean and dirty price, can somebody give an idea about what is clean and dirty price? Okay. Including and excluding the interest. Correct. So when I talk about dirty price, according to Europe, dirty price includes accrued interest. Interest is added in bond price. So basically, when I talk about dirty price, say for an example, some interest that is not being paid is also included in the bond price. So how do you calculate? So if you look at the example, if the bond price purchased before interest payment due date, so we will have a problem after this also, where we will do a bit of brainstorming. So if the bond purchased just before interest payment date, then the price is, say 20 is the interest, then the price is 960 plus 20 is 980, right? So I'll show you a problem. Now look at this problem. The face value of a bond is 10,000 and the coupon rate is 5%. A remaining time to maturity is 5 years and YTM is 4%. Find the clean price of the bond. So that you can find out, right? Clean price of the bond means nothing, but you find out by, the by discounting method, you will find out the clean price of the bond. But the face value of the bond is 10,000, coupon rate is 5%, and the remaining time to maturity is 5 years, out of which 6 months is passed. YTM is 4%. Find out the dirty price to the bond. So what happens is that for a clean price, you don't have accrued interest. For the dirty price, there is an accrued interest of how many months? How many months there is accrued interest? 6 months ideally, right? Correct. So now quickly find it out. What would be the clean price and what would be the dirty price of this? So we know how to find out a price of a bond. So the first method, so the first problem will have the similar method. Sorry. The second problem will have something additional. Please find out both the values. Guys, done? Done? Could you start writing the result? Are you guys doing? Finding out the value? Clean price and dirty price? If you don't understand, I can show it to you. Yeah, please find out. Otherwise, I will show it. For the people who has not understanding, I will show it to them. Don't worry. Yes, the clean price is 10,445. Okay. And what's the dirty price? What's the dirty price? Yeah, correct. So 250 rupees. So 250 rupees for 6 months interest, accrued interest. So the dirty price is 10,695. Correct. Anybody who could not understand this, then I can show it in Excel how to calculate clean price and dirty price. Please raise their hand or please mention in the chat box who has not understood. I'm going to show it to you how to find out clean and dirty price. Yes. Anybody else? Vishaka. Okay. Anybody else? Tanumay. Okay. I'm going to show you how to find out clean price and dirty price. Sure. So what does my problem say? My face value is 10,000, right? So face value is 10,000. My coupon rate is 5%. 5%. And my YTM is 4%, I guess, right? 4%. And my time to maturity is 5 years. So when I find out clean price, so what do? I have time to maturity for 5 years. 1, 2, 3, 4, 5, right? So what is going to be my cash flow for year 1? It is again 5% of 10,000, right? And this continues till for these 5 years. Arey yaar. Right? But at the 5th year, what is happening is this also is my terminal value that I'm getting, right? So my total cash flow for 5th year is 10,500. Now I have to discount it, right? I have to discount it. So let us keep it here. I have to discount it by what? I have to discount it by the YTM, right? So let us use that NPV method only. Eh? I use rate and then I use the cash flows. This is my clean price, correct? 10,445.18, or you round it off to 445 only. This is my clean price. Now, what is dirty price? Dirty price says that 5 years maturity time is there, but already 6 months is gone and no interest is being paid. Right? No interest is being paid. So what happens? Additional interest for 6 months is to be paid. So that comes to what? So if 500 is my interest for 6 months, then 500 is my interest for the entire year. For 6 months, how much it is? 250, right? So I have to add 250 with this. This is my dirty price. There is an accrued interest of 6 months, and this is my dirty price. So this is my clean price, and this is my dirty price. Now, is it clear to all of you? Is it clear now? Hello. So this is how we find out clean price and dirty price. Right? This is the determinants of interest rate. So how do we determine interest rate for a fixed income security or a debt or a bond? So there is real risk-free rate of interest. So one is where we consider there is no fluctuation in the market. Market is absolutely stable. There is no intervening variable, no risk, nothing. So we get a risk-free interest rate. Plus inflation premium. So there is something called inflation. So when I have purchased it, probably the inflation was X and now it is X plus N. So that N has to be the increase in inflation. So I need to be compensated with a premium for that, which is inflation premium. Next is default risk premium. What if the party defaults in returning me the money? There has to be a default risk premium. Next is liquidity premium. And then maturity risk premium. These are the 5 items which we take into consideration for calculation of a rate of interest. Now consider this as a case. Read the case carefully, thoroughly, and then we will solve the problem. Face value 1000 rupees. Coupon rate is 5%. Sorry. Maturity 5 years. Market interest rate is 6%. Now, relationship with the market interest rate, assuming the bond is issued when the market interest rate is 6%, the bond's coupon rate is 5%, suggests that it has a lower yield compared to the prevailing market rate. Consequently, the bond may be less attractive to the investors, resulting in a discount, right? So there is a discount premium risk. Credit risk, if XYZ company's creditworthiness weakens, investors may perceive it as riskier. This perception may result in a downgrade of the bond's credit rating. Assuming that bond's credit rating is lowered, the market may require a yield to compensate the increased credit risk. Let us assume that credit downgrade leads to an increase in the bond's yield to 7%. So the market interest rate was 6%. Now, because of the credit risk, it has increased to 7%. The bond's yield, right? Maturity, the bond's maturity also influences the yield. Generally, longer term bonds tends to have higher yields to compensate for the increased risk associated with the longer time. Now, assuming that upward sloping yield curve, the long-term rates are higher. Let's say the market interest rate for 10 years of the bonds is 7.5%, right? So again, from 6% to 7.5%. Next is supply and demand. The supply and demand for bonds can affect their yields. If the market demand for XYZ companies' bonds increases, the bonds yields may decrease due to the increased demand, making it more attractive to the investors. Conversely, if the demand decreases, the yield may increase. Let us assume the demand leads to a decrease in the bonds yield to 6.5, right? So here is a difference between what we call supply demand risk, right? Then it is inflation. So liquidity premium, default risk premium, maturity risk premium we have considered. We have considered credit risk, and then last but not the least is the inflation expectation. If the inflation expectations rise, investors may demand higher yields to protect the erosion of the purchasing power. Assuming the inflation expectation increase, and let's say investors are now require a higher yield of 7%. Now you tell me what is the rate of interest for this instrument. So maturity risk is basically when it is for a longer term tends to have higher. So see, you invest for a short term, you can invest for a long term, right? There are two options. Now, when you invest for a higher term, for a 10 years, 20 years, so there can be lot of fluctuations which you don't know. Correct me if I'm wrong. Am I right or wrong? If you invest for 3 years, at least you can foresee what is going to happen 3 years down the line. But if you invest for 20 years, there could be lots of up and downs. Is it right or not? Yes or not? So, no, it is not default risk. Default risk is something else. Default, yeah, for the fluctuations, it can lead to default. It can lead to, reduced present value of your earnings. So it may not, it is not a default risk. It is a maturity risk. So when you have a longer term of maturity, then obviously you have certain things which you cannot foresee. So you need a premium for that, right? So that premium has to be taken into consideration. You can say it is a duration risk. You can say it is a duration risk. Okay. Now, given all these figures, what is the bonds yield you need to find out? Please find out. What would be the bonds yield? Please find out. Very simple calculation. You can go to the snipping tools and you can go to the previous slide and take a snip of this. Taken? Okay. Now sort out the problem. Solve the problem. Please solve the given problem. Let us see what about others. Then we can calculate also. I will calculate in Excel. But let us see what others have found out. Someone has got 8%, someone has got 7.5%. Both are different. What about others? What about others? I'm going to do it definitely in Excel. That's a separate thing. But what about others? Hey guys, what happened? What about others? Now this is another reply, 7%. So I would like to see few more reply. Then I'll do the calculation in an Excel sheet. I'll show it to you how it gets calculated. Few more reply, please. Out of 28, I have got only 6 or 7 reply. That's it. Now it's 7.5. So someone has written 7, someone has written 8, someone 7.5. Okay, next. Few more. Few more, please, guys. Now there's a new reply. Seven. What about others? How many response we got actually? 1, 2, Manish, Kishore, Praveen, Yashwan. That's it. Shreya. Shreya has given reply. First 7.5. Manish, Yashwan, hardly 6 or 7. That's it. Okay. Let me do it for you guys. So understand one thing. When I go to the PPT, what are the things I have to consider? One is real risk-free rate of return. What is my real risk-free rate of return here? What is my real risk-free rate of return, which will not fluctuate, but I am guaranteed to get it? 5%, correct? So when I talk about this, my real risk-free rate of return, say R dash comes to 5, right? So I'll remove the column of percent from here. Should be a number or general, that's it, a number. Five, right? Next, what they are saying, inflation premium. Inflation premium, right? Inflation premium. Now let us have a look on the problem once again. What is the inflation premium? The expected return due to inflation is 7%, right? Bharat, risk-free rate is the coupon rate that is guaranteed to you. That is 5%, the coupon rate that is guaranteed to you, right? Now the ongoing market interest rate is 6%, but the investors expect 7%. So what is the inflation premium here? What is the inflation premium here? Correct, Kamlesh. So it is 1%. So again, when I talk about inflation premium, it is 7 minus 6. Seven minus 6, 1%, right? Next is default risk premium, right? So my next is default risk premium. So this is how actually, even in loan, interest rate is arrived at. This is how we calculate interest rate. Even the banks calculate interest rate. Now we are talking about default risk premium, right? Now when we talk about default risk, we go to credit risk, that is point number 2. Again, what is the increase in bonds yield or the expectation of the customers or the investors in the bonds yield? That is 7%, and the ongoing market rate is 6%. Again, what is the default risk premium here? What is the default risk premium here? 1%, correct. Bharat, it's not 2%, it is 1%, because the differential amount is with the ongoing market rate, right? It is 1%. So when I talk about the risk, default risk premium, it is again 7 minus 6. That is 1%, right? So I got my default risk premium. Next is, did I get my liquidity premium, right? What is my liquidity premium? And the next one I have to find out is maturity risk premium. Yes. premium, right? Let us have a quick look on the problem. So when it talks about liquidity premium, means how much liquidity the bond is having. Like if I want to sell it, how quickly I can sell it. So that again depends on the demand and supply gap. So look at point number 4. The supply and demand for bonds can affect their yields. The supply and demand for bonds can affect their yields if the market demand for XYZ companies bonds increases. The bonds yield may decrease due to increased demand, right? It's an inverse relationship. Conversely, if the demand decreases, the yield may increase. So I assume that the demand decrease and yield increase. So the investor will expect a higher rate of return, and that is 6.5. So what is my liquidity risk premium? What is my liquidity risk premium? 0.5. Correct. So it's 6.5 minus 6. 0.5. The next point is my maturity premium. Due to a longer term maturity, investors expect a higher yield, that is 7.5%. So when they are expecting 7.5%, what is my maturity risk premium? What is my maturity risk premium? 7.5%. What is my maturity risk premium? Correct. So 7.5 minus 6. 6 is the ongoing. Now my required rate is summation of this 5. %9 is my required rate. Neither it is 8%, not 7%, not 7.5%. Yeah, let it be for 5 years. So what? This is how we calculate the required rate of return for any debt instrument. No, this is not 7 minus 6.5. Tanumay, this is not 7 minus 6.5. What is the inflation expectation? 7 minus 6. 7 minus 6. It is 1. So 9% is the required rate of return. So when we say that this bank is charging 12% or 13% or 14%, what are the factors that affect most? These are the factors that affect to decide a rate of return. Now tell me one thing. Why is the rate of interest more for Bajaj Finance compared to ICICI Bank? This is a market acceptable method. You can talk to any analyst. There is nothing called theoretical in this program, Kunal. Okay. Now my question is, why do you guys think that the rate of interest for Bajaj Finserv is more than compared to ICICI Bank? Credit rating is one part. Next is, what kind of risk premium is getting added for which the rate of interest is going up? Lower cost of capital is one part. Second, so if NBFC is more risk taker, so what kind of premium is getting added to the risk-free return, which is causing the rate of interest to go up? Market risk or default risk premium? That is default risk premium, right? Other than that, all the premiums are similar to all the banks and NBFCs. Liquidity premium is one portion. Now you see, when it is a longer term investment in loan also, say you are taking a loan for 20 years, a home loan, the risk you factor into is much more compared to a small consumer durable loan, which is for 6 months. Right? Yeah, you can say this is the method of calculating rate of interest. Could be. Okay. Everybody understood, or any more clarity is needed on this part? Any further clarity is needed? Yeah, Bharat, please tell me. I have to unmute you. Let me see if I can.
Hello. Sir, can you hear me?
I can hear you, Bharat.
Yes,
Tell
sir.
me.
Sir, see, first is when you say the risk-free rate, okay, don't we consider, we consider generally the GSEC rate with the similar tenor as the risk-free rates, right? Why should we start with the coupon which the issuer is offering, sir? Why should we take that as the risk-free rate, sir?
That is because this is the committed rate from the issuer.
No, but when someone says risk-free rate, we always take the government security or the T-bill rates to be the risk-free rate, right?
Government security rate is uniform across all the instruments.
No, that there is
Correct.
one
So that is
single.
the point, Bharat. That
Sir,
is the
yes.
point. That is the point.
What, sir?
So here the committed rate is 5%. So we will start with committed rate, not with the GSEC rate.
No, but
Because
for
it is not
example,
uniform.
if he's committing 2%, sir, okay, then I cannot apply all. But for
So
example,
you are not asked to apply it on all the things. You are asked to apply it on this instrument particularly.
No. I'm saying in this instrument only.
Yeah.
For example, the GSEC rate, prevailing GSEC rate is 5%. Okay, sir. I'm saying for the 5-year maturity. But the company is giving me only 2%. Okay, as the committed rate. Then when I start for my calculation for all the credit risk, liquidity risk, and all that, I should always start. I should always look at the GSEC rate, right? Because he's offering me some rate, I cannot start with that, no, sir. That is, and we call that also risk-free rate. That is why I have a doubt, sir.
So that is an uniform you across industry when you do it. But when you do it for a specific instrument, How can you consider a rate which is more than the committed rate as the base rate? You cannot do that, Bharat.
Okay, sir. Okay. And one more doubt, sir. On the maturity risk, sir. Here,
Yeah.
I think many people also ask similar is the same question, sir. That how can we consider the 10-year bond rate for a 5-year bond, sir?
No, that's something which is written, you are saying, right? So one second, hold it. I understand your question. Maturity, right? Let me have a look.
Yes.
So actually, I should have written it 5 years, 5 years, but 5 years when due to maturity, it increases to 7.5%. So it's not a comparison between year to year, it's a comparison between ROI to ROI. Please ignore that 10 years wala.
Okay, sir. Right, sir. Okay.
Okay.
Thank you.
Thank you so much. Thanks. So Amit Kapoor has replied, which is why take either 10-year G-Sec or similar maturity and the quantum of premium. Okay. Can we go ahead? Is the question answered? Okay. This is a typical curves yield versus maturity for different kinds of graphs which we see. There are normally 5 types of curve which we see based on yield versus maturity. Some curves are very steep, some are humped, some are flat curve. So even with increased maturity, the yield doesn't change, and some are inverted curves. Just to give an idea about how curves looks like, and then you can practically apply all these based on certain data, and you can see how the curves looks like. So this portion you can say uh, to some extent theoretical, but based on the practical observation. Sorry. Now I'll talk about concept of modified durations. So modified duration is a measure of the sensitivity of the bond's price to change in its yield or interest rate. So when a interest rate change, how the bonds price change and what is the sensitivity. So for every unit of interest rate change, what is the change in the bonds price, right? A modified duration takes into account the time to maturity, the coupon rate, and the yield of the bond. It is calculated as the weighted average of the time until each cash flow, coupon payments, and the bond's face value is received, with weights being the present value of those cash flows. The formula for modified duration. So 1 by P, P means current price of the bond, T is the time until the cash flow is received, present value of T and the cash flow of T. So there we get a modified duration. Now I have given, again, this is a formula which you can take a snip, and then there is a problem. Take a snip of this formula, and then there is a problem. So Yashwant, this is a good question which you have asked, how banks know all these parameters. So they have a set of analysts which who are working there. They can, if in fact they they use predictive models by which they find it out. But however, it might not be 100% correct. It keeps on changing. Okay. Could you guys take a snip and then I'll proceed and we'll go to the problem. Just confirm yes or no. Okay, everyone. So using this formula, you are supposed to find out the problem is no, understand this page as well. The price value of a basis point is also known as, so why did I talk about your modified duration? Because that is used in price value of basis point. The price value of basis point is known as a dollar value of basis point, represents the change in the price of a bond for a 1 basis point change in the yield. So again, the same thing. How much my bond price is changing based on 1 basis point change in the yield. It measures the sensitivity of the bond's price to the change in yield. To calculate the price value of a basis point, there are 3 steps. One is determines the bond's modified duration. So we know the formula. Convert the modified duration to a decimal and then multiply it with the bond price, right? So now I'll give you a formula. So for an example, I'll give you a problem rather. Current price of a bond is 1150. P is 1150, right? T is 5 years. 5 years. Right? And say R is 6%. Or the coupon rate is 6%. And YTM is say 7%. Right? So you find out the PV T and you find out FP FVT and then you find out the modified duration first. This is the first thing you have to do. And then we will find out the price value of basis point. Okay. So P is 1150, T is 5, coupon rate is 6%, YTM is 7%. Find out PV and FP. Sorry, PV and CF, cash flow. And then find out modified duration. Up to this much you do, 10 minutes is given. Find it out and then we will find out price value basis point. Clear, guys? Clear? Clear to everyone? Find out modified duration. Yeah, face value you can consider 1000. Done, guys, everyone. Hello, done or in process? Okay, complete and tell me. Ideally, yes. So you can consider it as 950. Chalo, I understood. ठीक है. Consider it as 950. What about others with the given figures? Guys, make sure you are, yeah, that's quite close. Can you send all these workings to Equalify as well? Just I can have a quick look on this. Please send it to Drishti. I think Drishti, right? Uh, or someone with whom you are coordinating. At least send it to them, and they can send it to me. Honestly speaking, the first assignment I did not get. Okay, whoever else has done it, please put it in the chat box. What about others? You can consider 950 and also count whoever has not done it. But what about others? Okay, let us go to calculate price value of a basis point, right? So we know the modified duration is 4.16. Considering the given values, it is 4.16, right? Modified duration. Now I have to find out the price value of a basis point, right? So now how do I find out the price value of a basis point? One is, how come it is 39.5? Can you write in the chat box how did you get it? Into 950. Okay. One second. Let me confirm it. 4.16 means 39.52. Yes, correct. So now what do I mean by this 39.52? What do I mean by this 39.52? It is same, like if you even if you consider 0.95 into 4.16. So what did I do exactly? It's not 0.95, it is 9.5. It is 9.5. So if you divide 950 by 100, it is 9.5. So the result will be same. It's 9.5 into 4.16. So it is again 39.52. So bond prices change by 39.52 with every change in the interest rate or yield, with every change in yield, right? So the for 1 basis point change in yield, my bond price change by 39.52, either in dollar or in rupees. That is what we wanted to find out, that what is the sensitivity. What is the sensitivity to the price of the bond for a change of 1 basis point in the yield? So not 1%, it is 0.01%. So which is 1 basis point. So in Hindi we call it ek paisa. एक पैसा, एक टका नहीं, एक पैसा. So 0.01% change in yield will result to 39.52 units of change, 39.52 rupees or dollar change in my bond price. That is a sensitivity. Correct? It is 3%, 3.9%, Yashwant. Because look at the price getting traded at 1150, sorry, 950. So if it is getting traded with a face value of 1000 rupees, is 3.9%. I don't think it is too high. Again, the figure which you are getting is based on the figure that is given in the problem. In real life scenario could be something else. So I would like to ask Praveen particularly about this question. I don't know, Praveen, whether you have worked with bonds or not, or somebody else, whoever is there in this group right now. Normally, what is the PVBP you have seen in normal scenario? Anybody who has worked with bond can give throw some light on that. It is PVBP, price value of a basis point, 6.7 to 7%. No. What is the PVBP? Normally you have seen. A modified is okay, understood. But what is the PVBP have you seen? So if it is 7 paisa means 0.07%, right? When I say 7 paisa, it means 0.07%, right? So 0.01%. So what I am getting here is around 3%. No. If you convert it in the terms of percentage, then what it could be like here, it is something around around 3 to 4%, 3 to 3.5%. Right. It depends on bond. It depends on multiple factors and also the real life scenario figures. So these figures are actually arbitrary figures. Like it's just given. Bharat, could you elaborate this? So modify duration into. Acha, unmute. Okay, 1 sec. Yeah.
Yeah. So can you hear me, sir?
Yeah, Bharat, I can hear you.
Yeah. So generally in a 10-year GSEC, 1 basis point or 0.01% is actually 7 paisa is the change. So here in this case, there's a 3% is what you saw as a modified duration. So in that case,
That is based on the figures given. So
yeah, based on the figures given. So
the objective
in that
is
case,
to understand. The objective is to understand the formula and the concept.
Yeah.
Real life figures could be different.
Yeah, so here, for example, if we take that 3% or 3 years as a modified duration, in a 10-year GSEC, it will be 0.07 paisa into 300 basis. So 3% is 300 basis. So that is the value for a 10-year GSEC at this point of time.
Okay, it is normal trend of the market, right?
Yeah. For the 10-year, it is like that. But for example, a 5-year, it will be much lower. It could be 5 paisa, 6 paisa.
Okay, understood. So that's the real life scenario.
Yeah.
Okay. Any source where we can get all these things, like when we saw, like where from in the any open source, can you name it? Like just
see, actually, what we can do is if we see that CCIL website, ccrindia.com, that gives the latest prices in terms of the GSEC traded prices. So there we can see what is the current yield, what is the current price. So for example, at present the 10-year is around 7.02 or 03%. And the price will be around 101.6 or 5060, like that. So similarly, we can compute if, for example, 7.05, your price is 101.50. If it becomes 7.06 for if the yield goes up by 1%, then how much will the price go down? We can do the computation by ourselves.
Come again, please, Bharat. Once again, please.
In the ccrindia.com, they'll give you the current prices of various government securities, state government securities, and all that. So, for example, at present, the 10-year GSEC is at 7.03%. And and at 7.03%, the price is around 101 point.
7.03% is what? The base price you are saying?
No, that is the GSEC yield. That is the 10-year yield.
Okay, GSEC yield. Okay.
GSEC yield, 10-year GSEC yield.
But that's not the coupon rate.
No, that's not the coupon rate. The coupon is 7.26%. Okay.
Okay, so there is a 40 basis point difference.
Yeah, there's a 23 basis. 7.26 is the coupon. The yield is 7.03. So which means the yield has gone down by what? 23.
7.03 or 7.30?
7.03. That is the current 10-year yield.
Current yield, and your coupon rate is
7.26.
26.
Yeah.
So 23 basis point difference.
23 basis points has already fallen. The market has already fallen. At 7.03%, the price which comes to 101.55. Okay, not very sure of the number. It will be around 55 to 60. So if we want to know what is the price change for every one basis, we can actually compute it by finding out at 7.03 the price is 101.60. What will be the yield? What will be the price if the yield actually goes up by one basis or goes down by one basis? And thereby we will know what is the PV01.
Okay, understood. But the concept is similar. So you apply the same concept there.
Yes, sir. So we can apply the same concept, sir. See, generally what we do is we use the cash flow and find out the price for every at different yields. But using the modified duration and the price of the bond also, we can find out the price.
Correct. So the concept is same. Only thing is that because these are not real life figures, so the figures is the percentage which is coming out is slightly, slightly outlier from the normal trade.
Yes, sir. Yes.
So I understood. Okay. Thank you so much, Bharat. Thanks.
You,
Bharat, you are working with some company? Hello, Bharat?
Yes.
You are working with some company?
Yeah. I'm working in an insurance company, sir.
Insurance company. Okay.
Yeah.
Thank you so much, Bharat.
Thank you, sir.
Thanks.
Thank you.
Okay. So we got an idea about how to calculate the present value basis point, right? Then we will talk about the Macaulay duration. Now, what is Macaulay duration? It's a measure of the weighted average time it takes to receive cash flows from a bond, including both the periodic coupon payments and the final principal payment. It provides estimate of the bond's price sensitivity to change in yield. So this is to some extent like the previous one, but only thing is the concept is slightly different. Where we get is the time, we get cash flow at the period point of at a time period T, we get the price of the bond, and we need to find out the Macaulay duration, right? Again, please take a snip of this. What is the concept of Macaulay duration? It is a measure of weighted average time it takes to receive the cash flows. So I get cash flows, right, from a bond, both in periodic and the final, that is the terminal value that I receive with the principal payment. The Macaulay duration is the weighted average of the time. So what is the time, average, and the weighted average, right? So now just use this formula in solving a problem. In the next sheet, you will get a problem where we are going to use this formula. Please take a snip of this. So, done? Everybody? Okay, let's look at the problem and let us solve it. Please calculate Macaulay duration. So tomorrow's session, I have tried to make it slightly on the interactive basis and less in terms of numericals. I know like from the first class, there had been too much of numericals. So tomorrow's class, I tried to keep it slightly, less numerical and more on the interactive basis. So this is also interactive. So we are interactive on many things. Well, again, we have taken some arbitrary figures. So it's not that key thinking on that. We have done that. See, macular duration is more than the modified duration. What can be the reason? Sure. Acha. So this is your observation, a general trend, is it? Okay. Sure. Acha, in mutual funds, you have seen Macaulay duration is more than the modified duration. Guys, whatever questions you have now, send all these questions to Equalify that we want to get it clarified from Abhijit. I will reply to all the questions. Don't worry. Do send and ask them to send it to me. Okay, now let us solve this problem quickly. Okay, what about others? What about others? What about others, guys? Only Harshita has replied. What about others? Done, everybody? Can you please write yes or no? Chalo. I assume that everybody is done with this. Let us go ahead. Well, this is the last topic of the day, impact of monetary policy on bonds. So normally, what are the impact of monetary policy we see on the bonds? First one is interest rate. So interest rate is directly proportional to bonds coupon rate. So when we talk about 1,000 rupees bond, 1,000 rupees 5% bond. So where from this 5% comes? This comes based on the current ongoing interest rate of the market. Next is bond price and yields have an inverse relationship. So that we have seen multiple times. So with multiple example, we have shown you that yes, bonds price and yields have an inverse relationship. When the interest rate rise due to tighter monetary policy, existing bonds with a lower coupon rates becomes less attractive to investors compared to newly issued bonds with a higher coupon rates. So obviously we have seen that with the increase of interest rate, obviously the bond price, that is inverse relationship. So next is market expectation. If central bank signals a potential tightening of monetary policy, such as raising interest rate, it may cause bond yields to increase as investors anticipate higher rate. So what happens is that you have two options. One is invest in a 6% coupon rate bond. Another is you expect the interest rate could rise to 8%. So obviously you will abstain from investing in a 6% coupon rate bond, and you will be waiting for a raise in interest rate in the market, and then you would like to invest in that one, second one, right? Which will be more lucrative to you from the investment perspective, right? Coming to the investor sentiment, that's the fourth point here. When central bank adopts tighter monetary policy, it may indicate concerns about inflation or overheating, which could increase risk aversion among investors. So this can result in a shift towards safer assets such as government bonds, causing their yields to decrease. Again, what happens is, suppose there is a turbulence in the market which is anticipated. Could be because of a war, or we have seen a pandemic for around 3 years almost. So what has happened is, whenever such kind of turbulence is seen, people shift towards government bonds or slightly safer instruments. And the moment there is a high demand for that kind of bonds, then obviously it leads to a decrease in their yields, right? People are ready to pay more, the yields comes down. Price of the bond becomes, shoot up, it increase, and the yields come down. Last is the yield curve. When the central bank raises interest rate, short-term rates tend to increase more quickly compared to long-term rates. This can lead to flattening of the yield curve as the yield difference between short and long-term bonds narrow. Conversely, when the central bank lowers interest rate, it can stiffen the yield curve as the spread between short and long-term widens. Can somebody explain this? Otherwise, I will explain how this yield curve is important here. Can somebody explain this? Question to Praveen and Bharat mainly. Can you write in the chat box, please? Your last point. The question is, short-term rates tend to increase more quickly compared to long-term rates once central bank raise interest rate. This can lead to a flattening of the yield curve. Just read point number 5. This can lead to a flattening of the yield curve as the yield difference between short-term and long-term bonds narrows. Conversely, when central bank lowers interest rate, it can steepen the yield curve as the spread widens between the short and long term yields. Current US situation, but reasoning and the after effect not known. Okay. Praveen, can you throw some light on this? Or Bharat? Yeah, that is mentioned here because of the monetary policy, the shorter end of the curve yielder flattener, whereas the fiscal policies impact more on the long side of the curve, that is bond with higher duration yield steepener. That's true. That's true. So when there is an increase in interest rate, obviously the yield. So Praveen, the question is, when central bank raises interest rate, the short-term rate all of a sudden increases more quickly compared to the long-term rates. Now we know that the yield for or the interest for long-term rates is always higher. So what happens? Because the short-term rate almost becomes similar to the long-term rates, so the gap between the short-term yield curve and long-term yield curve narrows. On the other hand, when the central bank lowers interest rate, then what happens? The short-term rate falls. Long-term rate doesn't get much affected. So the gap between short-term yield curve and long-term yield curve widens. Now is it clear? It depends on the spread. Right. It is already right. It is already explained. Yes, Bharat. I will.
Sir?
Yeah, Bharat. Please tell.
Yeah. See, generally what happens is the short-term rates are directly related to the repo rates. So
Correct.
what happens is, as the central bank tends to increase or decrease the rates, increase or decrease the repo rates, the short-term rates actually tend to go up or come down in the same pace as the central bank tends to take the actions. So over the last 1 year, what we have seen is that the repo rate has been increased so quickly by 250 basis or by 250 basis or 2.5%, from 4% to 6.5%, which we are now. So since the short-term rates tend to move directly, short-term rates tend to have a spread over the repo rate, and then it tends to actually move in line with the repo rate. So that's why.
No, just a second. Just a second. You said short-term rates is a increase in short-term rate acts as a spread over and above the repo rate, right? You mentioned that, right?
Yeah, the short-term rates move in
So that
relation to the
that
repo rate.
250 basis point is over and above the normal previously existing repo rate of 400 basis point.
Yes, 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 sir.
Okay,
Yes, sir. It
correct.
was repo rate was 4%, then 250 base 2.5% was increased. Now it's at 6.5%. So
Correct.
the short-term rates, when the repo rate was at 4%, the one year T-bill was somewhere around what to say, 375 or even 4 quarter, around similar range. And now, as this 2.5% the repo rate increased, the 1 year T-bill rate is now around 6.75 or 7%. So the short-term rates move very quickly or in relation to the central bank actions or the repo rates. But The long-term rates, what happens is the long-term rates are more dependent on the demand supply.
Correct.
So there are institutions like insurance companies, pension funds, which always tend to prefer the long-term bonds in relation to the short-term papers. Hence, even as the rate tends to move higher, these institutions may not keep waiting for the rates to go up, and they will keep buying the long maturity bonds, because see, although the rates is not increasing as fast as a short term rates, it is still actually going up. Okay, hence these institutions tend to prefer them, because these rates are actually moved higher when compared to the previous periods. Hence they keep buying the long term bonds. Hence the rates may not actually go up as swiftly as the short term rates. But the logical thing is, it is always a spread. The 1 year rate and the 10-year rate, the difference between them is always is a 10-year average is around 60 to 70 basis. So what the market will tend to do is, they will want to have these this spread between a 1 year and 10-year being maintained. But the spread may actually come down or go up depending on the interest in the or demand in the market. So if the demand for the long-term bonds actually go up, this spread of 1 to 10-year, which we say as 70 basis, may actually come down, and the vice versa. And when
to
the
some
rates
extent becomes like this. So to some extent becomes like this. So where the short-term rate, we can see there is a steep hike, whereas probably in the long-term rate, there is a slight fluctuation, which is comparatively negligible in comparison to the short-term rate, short-term yield curve. Right?
okay.
So it is like this. On the contrary, when there is a decrease in rate, then the scenario gets reversed. So the first scenario is, when you raise interest rate, the short-term rate becomes short-term rate increase quickly compared to the long-term rates. So probably the gap narrows down. So when the gap was like, probably this is the long-term rate and short-term rate was like this, it increase. So the gap narrows down. And it happens reverse when the rate of interest is reduced.
Yeah. So, but one doubt which I have is, see, why should it always be like this? That when interest rates goes up, the short-term rates move faster than long-term rates, and when it falls down, short-term rates actually move slower than the long-term rates. But it need not be like this always, right? It depends on the liquidity in the market and the demand supply in the market. So is it something like a rule that it will always hold good, or that I cannot understand, sir?
Yeah. So it happens only because there can be a situation, rather I'll put my words in a different way. There can be a situation where you have alternate options of investment. Say equity market is too much attractive. Then what happens? Now, this is my question to you now. Equity market is too much attractive. Even with the increase in rate by central bank, the equity market, something is happening in the equity market which is too much attractive. Then what happens? Then does this rule is applicable? So what happens is that market sentiment and consumer psychology plays a vital role in this particular aspect. You got my point? Are you agreed, Bharat? I can't hear you, Bharat. I haven't muted anybody, but I can't. No, I haven't. I haven't muted. Rather, I have the mute all option. Where did Bharat? Where is Bharat? Yeah.
Yeah, sir, I can speak now, sir. Yeah.
Yeah. Tell me. So that to some extent depend on the availability of alternate investment and the consumer psychology.
Okay.
That is what I was telling. In case you have a very attractive, lucrative equity market or some other scope of investment, then probably there might be certain deviation to this rule, a certain exception which we will observe here.
Okay. But generally, sir, the equity market performance and the interest rate markets, it need not be like there need not be
No,
a correlation,
theoretically,
sir.
yes, theoretically you might not find correlation, but think from an investor's perspective.
Yeah, but even from an investor perspective, see, we are if we think from a retail perspective, it could be right, sir. Because
I'm talking about retail perspective.
yeah, but markets are not moved by the retail people, sir, because institutions they have some allocation strategy and all that, where so institutions are much bigger than the retail, right?
Absolutely.
So retail may not be able to move the equity or the debt market. I'm saying the correlation may not be able to work there. So if a equity market does well, it does not mean that the GSEC or the debt markets should actually not
So
be
you
performing.
asked me. So you asked me a question which is about the exception. You said I don't understand why there is a standardized rule that with the fall of interest rate, the gap narrows, and with the rise of interest or with the rise of interest rate, the gap narrows, and with the fall of interest rate, the gap widens. So you are asked me a question which is all about the exception. The standardized rule is this. I said there could be alternate scope of investment, which can be one scenario where you can see a deviation to the standard. So when I talk about standardized, a standardized, observation or the trend, then obviously this is the trend. What is being observed?
Okay, sir. Okay. Yeah.
Okay.
Yeah.
Thank you, Bharat.
Yeah, thank you, sir.
Thanks. Okay. Praveen, 1 second. Praveen has some point. Not fully, it will be. Doesn't it make logical sense? No. Praveen, I'm going to unmute you. I just wanted to understand what you are trying to say. Where is Miss Praveen? Yeah. Praveen, you can speak.
Hi, Abhijit. No, nothing as specific. I was trying to answer a few of the questions which Bharat had asked, which you have already taken care of. So nothing specific I wanted to add. What was explained is somewhere follows. There may be exceptions, but generally, if you see how the market behaves, so it tends to, and like you mentioned very correctly, there are a lot of sentiments, lot of qualitative factors also involved when we look into equity market versus bond market, and not always it moves theoretical. There are a lot of idiosyncratic exceptions to those as well. But generally speaking, if the interest rates increase, it impacts the equity market negatively, and vice versa. And similarly for bond market, we have also seen in CDS market, right? As closer you have to default, the spread increases, but there can be exception to those cases as well. Same for the yield curve, because short-term shocks bank try to arrest faster than the long term, because someone here mentioned, Tanmay, correctly, because there are a lot of factors comes into place when it comes to long-term market. So generally yields become narrow and narrow, and that's why it leads to flattening, and other way around as well if the interest rates goes down. So you have already covered those. So
Thank you, Praveen.
yeah.
So recently we have observed that there was a fall in Adani share when this event happened, right? Say it is probably a couple of months back, right? Not even a couple of months back. So how do you explain it? It's about market sentiment, right? Is it because overall as a company, Adani had faced a downfall? No, it's all about a market sentiment. They stepped back from something and there was a market sentiment which led to the fall of Adani shares. Yeah, it's Feb 2023. Feb or March, probably. I don't remember. Probably, yeah, Feb could be the right. Okay, guys. So that's all for today. Anything, any suggestion, any question, anything for me? And how was the session overall? Today's session, both the sessions I'm asking. Thank you, Praveen. Thanks, Jitesh. Thanks, Abhishek. Thanks everyone. Guys, whatever questions you have, probably you are not, it's not immediately, no, tomorrow there will be topic on credit rating. So tomorrow we are going to start credit rating for corporates, rating methodologies and all these stuffs, how the rating process happens, all these things we are going to cover tomorrow. And guys, you might come up with certain questions probably you have forgotten to ask during the webinar session. Do let me know through Equalify. Send your list of questions. I don't mind to answer hundreds of questions. I will send back to Equalify and you will get it. So in case they are not, your queries are not getting addressed, please write to Equalify. Well, PPTs ideally should get uploaded in the portal. I don't know how do they do it, but still I will talk to Drishti and I'll look into this personally. Videos and the recorded sessions will definitely get uploaded. Thank you so much, Praveen. I'm really honored to hear this. So this happens like at times we keep on doing something. So when I started my career, I was throughout into loan, initially into sales, and then into credit underwriting, and then right now I'm into automation of the lending process. A lot of things are involved, AI, ML, all these things are involved in my job. So might be in the day-to-day cases, even the basic things I forget at times. So when I discuss with somebody or I get a scope, it's a kind of brush up for me as well. Thank you so much, guys. Thanks for attending. Can we wrap up for the day? Can we wrap up for the day? Thanks a lot, guys. Thanks. Wish you a very happy Sunday to all of you. Thank you so much. Thanks. Bye. Take care. May God bless you.